Good afternoon. Thank you so much for sticking around to follow this conversation. I'm delighted to be joined by Dan and Tania, and we're going to be talking about how there is something of a reinvention of consumer tech. And it's great that we have both of you because you come at it from slightly different angles. On the one hand, of course, Gopuff is delivering food to our doorstep in 5 to 15 minutes at times, and you guys are at a slightly different price point. Maybe, Tania, I'll start with you. Like, you're in the health tech space, which is something that a lot of massive tech companies are looking at and doing things in. Where you guys are different is you're doing a product that is regulated. And I'm wondering how you firstly start selling that to investors to begin with, and then approach it. And how then, if there's a big company like Apple or Google, you guys are a big company, I mean a huge, massive monster mega tech, what learnings could they take from your experience?
Yeah, and just hi everyone, by ways of background, so yeah, I created Elvie, which we're building the first global tech brand for women's health. So we create connected devices, and Alex said a lot of them are in the regulated medical space. Our dominant category is breast pumps, so we've created the world's first silent wearable breast pump. In terms of scale, we're at about $100 million revenue, and 80% of our revenue is from the US. So I think in terms of your question of what makes us different, yes, we're about consumer tech, but I think we're part of a new generation of what we're calling personal health tech or consumer health, which is bringing together those traditional verticals of consumer tech and health. So what does that mean? It means really the products and services that we make we have to adhere to quite strict clinical standards and regulation. But we see this as a positive because it creates a lot of defensibility. But it's really about being innovative in how we market and sell it. So that's really doing it as a consumer lifestyle brand.
So when you say innovative in how you market and sell it, what would be different?
Well, our first category is pelvic floor health. Often women would wait till they have a yucky health problem. They go and see a doctor. The doctor will prescribe some sort of treatment. And generally, medical devices are not designed, they're designed in quite a utilitarian way. So we've designed our products which actually, it sounds so obvious, but they're customer-centric, women-centric. So women actually enjoy using the products, and then therefore they talk about it more. But in terms of the branding, for example, we launched our breast pump on a catwalk at London Fashion Week. For us, our social following is about 500,000, and we work a lot with influencers. That's not the traditional way to market a medical device, which would normally go to medical conferences and talk to physicians.
Dan, for you guys, it's a space that has exploded in the past few years, obviously during lockdowns. But when you set about, I think your company's 6, 7 years old now?
9.
9, my bad, I apologize. This is why we usually have editors. It was not as hot as it is now. How, in those early years in particular, do you go around selling the product? And it's quite a capital-intensive business, at least from day one. What was your sort of an initial pitch?
Yeah, absolutely. So just a little bit of history on the company. As Alex mentioned, it's a 9-year-old company. Started out in Philadelphia, back in the States. And the impetus of starting the company was really like, how do you make convenience more convenient? Because at the time, this is 2013, you don't have anyone really in the delivery space. I think today, all the companies that we know and order all of our goods from were just starting or didn't exist. And so the big difference in how Gopuff started versus like what you've come to know as third-party marketplaces is Gopuff is a fully vertically integrated model. So we operate our own micro-fulfillment centers. They're 8 to 10,000 square feet. We own all the inventory that we sell. In the US, that's over 4,000 SKUs. In the UK, it's a little bit less. And then we deliver goods to people in under 20 to 30 minutes, wherever they are, whatever they need. And that range of goods is everything from snacks, ice cream, and alcohol to baby, pet, beauty products, over-the-counter medication, things like that. When we started the business, the trend that we saw in technology, really out of Silicon Valley, was like building these asset-light marketplaces that connected couriers and merchants. And the problem with that was it's very hard, as we're seeing today, for a third-party business model to actually produce cash. And that's why you see a lot of third-party players start to invest in ancillary businesses. But also, you can't control the customer experience because you're delivering goods that someone else owns and manages. And so our founders, when they started the company, really wanted to make sure that they could control the entire customer experience and that the business produced cash. And so for the first 3 years, it was actually profitable, at which point we started taking on venture capital to expand the network, both domestically and globally. And today, where it sits is Gopuff covers around 1,000 cities across the US and the UK. We operate a little over 400 micro-fulfillment centers. We actually own over 400 liquor licenses. So there's a heavy infrastructure component to the business between the buildings that we manage the liquor licenses that we own, the technology that we've built. When we started, as you mentioned, we pioneered this instant commerce space. There was no off-the-shelf tech in terms of receiving product, picking and packing, and then routing and dispatching in this like micro or hyper-local environment. So we think what we've built is what the rails for the future of commerce will look like as consumers shift from the 2-day and 2-hour delivery to this concept of instant procurement of the goods that they want.
And that is, on a very high level, something that you guys both have in common. You are making, well, in your case making, and in your case delivering things, and you have fulfillment centers and manufacturing facilities, R&D, all that stuff. Do you think that era, the platform generation of companies that we saw only 6, 7, 8 years ago, is that dead, or has it outlived its usefulness, and the companies that were created in that era and are still around are the ones that are going to survive, and maybe we won't see so many new ones? Tania, I don't know if you have thoughts on that.
Yeah, I mean, I think there are similarities. They're both very capital-intensive businesses, and you have to constantly be analyzing your value chain to see where can you maximize profitability. So even though I agree it's better to go deep, there's still a lot of opportunity to be looking at that platform play. So for us, it's about, can we use the same back engine, the same infrastructure to support women at different life stages with different problems. So I don't think the platform play is kind of going anywhere.
In that sense, is it more a platform to link them to your products rather than just
As
a platform in and of itself?
Yeah. I don't know for you, Daniel.
Yeah, I mean, look, I would think about it a little bit differently, personally. I think the way that platform has been described or defined over the last 10 years has been very asset light. I think there's this company that many people may have heard of called Amazon that invested, $20 billion in infrastructure, or $60 billion.
They're the arm of AWS.
Yeah. A few people have heard of them. But they've invested tens of billions of dollars over the last 2 decades into infrastructure to build the largest global platform I think we've come to know, right? And if you remember back in the late 90s, early 2000s, the Amazon eBay debate was a hotly debated topic, and everyone was asking, the Amazon team why they were not going to this third-party marketplace model, right? How many people still use eBay? So I think the idea of investing in infrastructure up front in a very heavy way, that infrastructure pays back fairly quickly, and it's a one-time investment. And if you can manage that, you can avoid or endure a lot of things that are out of the control of many companies that, like an asset-light marketplace that owns nothing, can't endure. And what you can then do, which I think Amazon's kind of created a blueprint for this, is you can then take that infrastructure and open it up to enable whatever services you're uniquely positioned to provide for other types of companies and brands. And so I think to Tania's point, it's just an evolution of what a platform means, and I think companies who are betting on infrastructure early are the ones that will win long term.
And I would agree with Daniel, in terms of profitability on the value chain, but the problem is often investors, right? Particularly venture capitalist investors, they get very put off if there's asset heavy, right?
Yeah. Have
you found that as well, and particularly what's going on, right, with cash and so on?
Yeah, look, in the beginning, and I'm sure you guys went through something similar, but in the beginning, trying to explain to investors that we owned inventory and had buildings, you would watch their eyes pop out and their heads explode, in the conversation. And it was the investors that we were fortunate enough to bring on, who have been great supporters, who bet on us early. And now you look at the tides have turned, especially with this whatever you want to call it, an economic downturn, recessionary environment, depending on who's speaking. Companies that own infrastructure and manage the end-to-end or deep down the value chain are the ones that can survive what's going on, and the ones that and if you don't own anything, how do you make money, right? We joke that, I'm sure you guys are similar, we buy products and we sell it for more than we buy it, right? That's the core model. That's why the business works. Then we found unique ways to actually deliver those goods and do things differently. And so the investment community, we believe, has come around because we've shown that this model works. But in the beginning, it was definitely a challenge.
That idea, buying something more cheaply than you sell it for, clearly you guys were a big beneficiary in terms of demand, I assume at least, from the lockdowns. That this is when we saw the explosions of not just you guys, but in the UK we have Getir and Gorillas and plenty more besides. That was a very competitive time, but there was also a lot of demand. Were you still selling stuff for more than you paid for it, or were you just saying we're going to stomach a whole bunch of losses right now and gain share?
So I'd say 2 things. One, we never believed in raising venture capital dollars and then subsidizing acquisition costs. That's never been our model. In fact, the % of revenue that we spend on marketing is astronomically low. And most people would be very surprised when you see that, when you look at some of the other companies out there. That's an approach that a lot of other companies in our space took, and I think we can see that that's not worked for them. The second thing is anybody can sell $1 for 99 cents. That's not hard. We don't do that. We think pricing is important. We think promotion is important, but within reason. And ultimately, like, we want to provide a service for consumers that is a good value purchase for them, especially now more than ever. The pandemic itself, yes, it drove demand in the broader delivery landscape because people couldn't leave their homes. But really what it did for us was it accelerated the exposure to the breadth of our assortment for consumers. So we carry, like, there's no other platform in the world that you can get fresh pizza, beer, baby products, cleaning supplies, and home essentials in one basket for one delivery fee, besides us, right? And that's what it exposed to consumers during the pandemic. And so that's really where we were able to continue to expand categories. So yes, it was demand, but it was really more exposure to, like, you can get all of these things delivered in one basket, and that's really where we saw success.
There was also on the other side, and I'm going to come to your lockdown experience in a second, but real estate presumably was easier to get at a cheaper price than might otherwise be the case. Were you able to lock in some long-term deals, or is that going to start correcting soon?
I mean, look, we've always been very prudent with how we approach the deal-making side of things, whether it's real estate, acquisitions, fundraising, et cetera, and we're always looking for the right deal. The benefit of the way that the business is structured is the majority of our markets, the success are not predicated on, grade A real estate. Right? We need real estate that puts us with close proximity to consumers, but effectively we build networks in every city. In London, for example, we have 21 micro-fulfillment centers covering the breadth of the city. So we're designing these networks very thoughtfully to make sure that we can get goods to people wherever they are, wherever they need it. And it doesn't have to necessarily be, prime real estate. Certain exceptions in major cities, and it's going to be more expensive, but that's never been kind of like an issue for us. So the pandemic, we were focused very much on get your goods in stock, make sure they're there when consumers need it, and deliver as fast. And we were the only company that was able to maintain our delivery ETAs or SLAs for consumers during that time.
You guys were clearly at the hard end, I assume, we're at the hard end of some of the supply chain crunches. You're an electronics business. Can you talk me through when you first started to realize that was happening, and then how you adapted?
Yeah, so during lockdown, the tech sector obviously did quite well, and particularly health tech did well, so we were growing really quickly. But then it was last May, I think, the first component, the microcontroller, obviously the brains of our product. Even with hardware, it's always about forensic forecasting, right? But even if you get it right, even if you get the demand planning right, what you can't predict is obviously when suddenly there's this frenzy around component shortages. So even if we've talked to the component manufacturer and they're like, sorry guys, we love you, we love Elvie, but there's this multi-billion-dollar tech company that's kind of been our customer for years and jumping to the front of the queue. So it was really difficult. Essentially, we were inventory controlled last year. How do we keep the products on the line? I think anybody working in electronics last year had a really hard time. And then that was sort of compounded by the fact that then the retailers, our customers, started also panicking because they were out of stock and sort of behaving quite irrationally, either saying, look, we need all your pumps or we're going to delist you and so on. And then they started placing, and we've seen this, I think, across the sector, this is more Q4 last year, really high purchase orders and so on, which then has sort of artificially affected all the forecasts. And then what we kind of knew was happening, but obviously all the Asian manufacturers in Q1 have now ramped up the supply of all those components. So we've seen a sort of 180-degree turn from a complete crunch on the supply chain to now actually a glut on various components, and also hit, obviously, by consumer confidence. So it's been to keep using the word headwinds is a bit of an understatement. I feel like we're...
What does that do for your pricing? So if you presume you can't deliver as many as you might have wanted, were you then able to charge more to your channels, or do you keep the same price and you just take a hit on the margin, and then it clearly evolves in a different direction now?
I mean, the aftermath of the pandemic has just been brutal for margins for most companies, but also as well as obviously the supply chain issue, freight, air freight, and even power outages in China and so on. Like many companies, we had to make the decision to actually increase our prices. Which is a sort of natural, obvious response to inflation. But it's the more midterm thing we need to do is obviously be looking at our product mix, making sure that we're able to offer products and services at a slightly lower price point and adapt.
And so when the lockdowns ease, what was the sort of impact you saw on demand? Because I guess to begin with, you have a sort of return to almost solid state economics, and this is how the market should be, hopefully. But then that rapidly changes with inflation, the inflation story. Like how long did that happy period last, and then how did it change afterwards?
I don't know if we've had a happy. Whenever you're loss-making high growth, we're growing 80% year on year. It is that analogy of a car driving 100 miles an hour, and every part is changing on the inside. So as soon as we start getting the margins right, and then something else has been sort of hitting us. But I think what's happened this year, which is a big learning, obviously, is because any loss-making consumer tech company as well, an existential issue is your investors and to what extent you can secure funding from them. And because that has also shifted the attitude towards consumer tech and so on, it's pushed us all to pull forward on terms of profitability. So we were planning to become profitable in Q4 next year. Now we're going to become profitable in January, which is quite a big change, but really quite exciting as well.
Before I pose you a similar question, we did actually have a Twitter poll, which I hope we can bring up, where we asked, and clearly it's a Twitter poll, so don't afford it too much empiricism, where we asked people what habit that they adopted during lockdowns have they retained or maintained since then. And grocery, food delivery comes up, perhaps no surprise, video conferencing up top of the list. But all of the above is about 20%, so we can infer perhaps that 45% have kept grocery and food delivery. I don't know if we then also infer that 55% have not. What does that, when you guys came out of the lockdowns, was there a bit of a course correct? And what were the meetings like where you first started to see some data points that said perhaps we need to change things?
Yeah, well, first, I think the important thing to note about a survey like that is that 55% probably hasn't tried grocery delivery, especially in our category.
To be clear, it said, have you retained?
Oh,
Look,
okay.
It's a Twitter poll. We did not
to question the validity of the poll. It's more what I was saying is that the adoption rate in our category is still super low, right? There's still so many people. It's still less than like 10%. In the U.S. at least. I mean, some other countries have seen faster adoption in Asia and things like that. But like grocery, convenience, alcohol, these are slow adopting categories to delivery. In terms of like the adoption rate during pandemic, post-pandemic, like I said, what we really saw was the cross-category pollination of the consumer behavior. And one of the stats that like we've spent a lot of time focusing on is we see that consumers who are shopping 8 or more categories on our platform are 22 times as valuable.
I'm going to bring you back to the question.
I'm going to get to the answer.
Just because we've got time on the
no
clock.
problem.
So did you start to see a slowdown in demand, or was it a slowdown of growth? What was the actual behavior?
We're seeing a shift in behavior. And so what you're seeing is that consumers are shopping more frequently, spending less. And this was a behavior we were starting to kind of sniff out going into this recessionary environment, where that $150, $200 grocery trip is starting to go away because there's a lot of waste component to it, and consumers are now buying what they need when they need it. And so that's really the shift in behavior that we're starting to see: more frequent trips, less spend on a per trip basis.
And what does that mean for you guys? How does that pick at your model essentially?
I mean, look, the impetus of the model was to get people goods in 30 minutes or less, right? So if people are shopping us on an ad-needed basis, that speaks to our initial thesis 9 years ago that consumers wanted to have these things, like the access to these goods at their fingertips, in which they didn't have it before. So I think the model's built for that, this hyperlocal logistics model, and I think we expect that behavior to actually accelerate over the next 18 months.
And it's funny because we're completely different businesses, but we've had exactly the same behavior change with consumers since May. So we're still number one in breast pumps in the US, but women are just spending less. That category has really shrunk.
You alluded to the need to bring forward profitability, and it gets another question I was keen to tackle, which is just what the capital environment is like at the moment, and whether it's, I don't think either of you, well, I don't know, but if you needed to raise capital right now, how do you think it would be, and what sort of feedback are you generally getting from your existing investors? Tania, maybe I'll start.
We did actually, unfortunately, have to do a small internal round, which we've just closed. I mean, Elvie it's like many startups in the UK over the last 6-7 years, it's just been incredibly easy to raise money, and it's been a very easy process. And this year, everything literally changed overnight, right? So from having venture debt providers who are like desperate to give us term sheets, and then suddenly they're like, nah, don't take it personally, but we're not doing anything in the consumer space, anything with discretionary spend, and particularly anything which is loss-making. So we have seen that real shift in the UK. I don't know what it's like in the US, but absolute laser focus on profitability. For us at Elvie, I think the fact we've managed to bring that forward, and to your point about the assets, because we've got the underlying unit economics right, that we can actually get there within a couple of months has really helped. But I would, my general advice to anybody would be just to try not to raise money in this environment.
Yeah.
You're seeing a lot more downside protection, terms which we haven't seen on term sheets for a long time around liquidation preferences and so on.
Yeah. What does that mean for hiring? Does it have an effect of people going, well, actually, my options or my if they have an equity piece, they're not worth as much as maybe we thought they were going to be?
Yeah, well, we haven't done a down round. We've had to do continuation, but I think a lot of companies are obviously doing down rounds. I mean, the number of times my board members keep mentioning Klarna to me, and I keep saying, we're not Klarna.
Yeah.
we don't need 90%.
Much more complexity in that one, but...
I mean, I think you were saying before, you guys don't need to raise money, but I think with the last round was valued you guys at 15 billion.
Yeah.
So I guess maybe the hiring thing is perhaps pertinent for you guys as well, because do you have to come up with new valuation internally? So when you're telling people how much their options and things are worth, like how do you negotiate that element?
Well, look, I mean, I think we're fortunate to be well capitalized and not have to go to the market. I think it's not a good time to raise money and probably won't be for a while. The fortunate thing for us is we expanded a lot over the last 2 years, both infrastructurally and from a personnel perspective. So we're not in a position where, we're hiring hundreds of people right now. We feel like, we've gone through some major cost-cutting exercises over the past few months because, similar to what Tania said, it's fortifying the balance sheet today and putting yourself on a self-funded plan to achieve profitability. We're doing the same thing. But we have a really talented and big team. So we're not in the market looking for a ton of roles, with maybe the exception of our technical side of the business. And we still believe there's a ton of upside on the business. We haven't had real challenges on that front.
And we were just talking about this earlier, right? Because you've had to withdraw from Spain. I think that's public, and we've withdrawn from China. So I think it's just the environment at the moment. It's just making you focus much more on the short term rather than the more mid to long term strategic objectives.
Are there also some opportunities, created by this? Perhaps, weeding out some of the companies that perhaps don't have as resilient a business model, or is that wishful thinking from, that you would be pitching to your own investors?
Yeah, it creates a burning platform, right? So, similar to Gopuff, we've grown so quickly, right? And then things slow down slightly. So actually this burning platform it forces you to be more agile. Like, how can we fix our product mix? How can we diversify faster? And also even on the business model. So how can we move away from discretionary spend? So our breast pumps, for example, can be subsidized on health insurance in the US. So trying to look for more predictable income such as that.
I realize I failed you as an audience by failing to ask if you want to submit questions. We've got about 2 minutes left, so if you have any questions, please race to import them. This is entirely my bad. I apologize. I'm going to pose the same question to you, though. How are you finding the competitive landscape is shaping up, given the new headwinds?
Yeah, I think, look, we had the experience of a very unique competitive landscape over the last few years.
In the UK alone, there are a dozen companies.
Exactly. For 6 years, we had no competition. And then I think about 18 months ago, you probably had 30 instant commerce players globally. Today, there's like 4 or 5 left, right? We're seeing consolidation. We're seeing a lot of businesses go under. The infrastructure wasn't built properly by a lot of companies because it was done too fast, and they were using the dollars incorrectly, in our opinion. And so we think the consolidation will continue, and we think it's a huge opportunity. If you manage a better business, and to Tania's point, you're forced to think differently about the business in this environment. We think it puts us in a position coming out in a few years as the global leader in this space, undeniably.
If there needs to be a roll-up, would you guys have the capital, or would you need to go and find money elsewhere?
We feel really good about the business that we've built. I don't think we see a need to expand by acquiring competitors, right?
Although that is what you've done historically.
Yeah.
But that's
Historically, but that was entering a market, and that was before this wave of these players. So we were actually one of the first to make that kind of move, and it was before some of the irrational valuations we saw in the space.
And I would say actually it's the same. So femtech, women's health tech, there's been a plethora of early stage startups. But what you're seeing here in the UK is particularly the ones that are not revenue generating. They're the ones who are being punished the most in terms of the investor climate. So unfortunately, quite a few are going bankrupt. So similarly, there's definitely a lot of opportunity for consolidation. I think also there's increasing amounts of funding, to your point exactly, for doing that mop up.
We do have a question. I'm going to slightly paraphrase it. The question is, how would you describe the impact of the pandemic on consumer tech? What I'd actually be interested to ask is whether it benefited your company and whether it benefited your industry. I'll start with you, Tania.
Simple answer, no.
Okay.
Well, I think the impact was early adopters became the norm, right? Like that's what we saw in a lot of space. I think undoubtedly it impacted in a positive way both our industry and our company.
Well, thank you both for joining us on stage, Tania, Boler, and Daniel Folkman from Gopuff and Elvie, respectively. And I hope that you enjoy the rest of the panels this afternoon. Thank you very much.